Hello! ContextLogic, or Wiz.com as it's most commonly known, is one of those companies that portray what I have been saying for many months since I started the channel really. That you should always be buying value, because if you enter in a company that's just hyped up, you could find yourself losing a lot of money, at least on paper for now. So if you bought around here or even here or even here, you have lost a lot of your money. The company has lost 90% of its stock price value in a year, which is absolutely insane. Basically, more than 90%, 91%. And you may be wondering, is this company going to bankrupt? But I do want to examine this company because a lot of these kinds of companies may not be worth buying at 40 or 30 or 20 or even 10, but there is, for the most part, always a point that it's potentially worth to buy, worth buying. And this obviously has to do with what the company is doing financially, of course. But if there is some potential for the company to reverse things and do well, we could actually purchase a few shares over here and find ourselves holding something that's very lucrative for the long run. And so it may be worth taking the risk to pay $2 for a company that could potentially grow a lot in the future. So it's at least interesting to examine. I mean, I don't want to exclude these kinds of companies just because they went down a lot, because it can happen. Now, let's take a look at what's going on here. So the company has a market cap of $1.5 billion and outstanding shares of 643 million. That's going up a little bit. So the company is diluting investors slightly. You would kind of expect that with such a new company that's trying to make some money and some cash flow. So they're selling stock to investors. That probably doesn't really worry me that much for this kind of company. So financial analysis. Let's take a look at the income statement. Interestingly, the company's year-over-year growth is a little bit all over the place, I guess. It did have 33% of a growth in 2020. Currently, in the last 12 months, 11 to 12% almost. It's fair, but the gross profit growth has been going down over here. Although the actual profit of the company is not bad at all over here in terms of the gross profit as well. But let's take a look at what really matters, which is like the net income at the bottom line really. And so in the net income of the company, you will see a company that's actually losing money and losing a lot of money over here. I'm assuming that's because of some expenses that the company has. And you can always take a little bit of a deeper look over here and see what kind of expenses. This is probably the selling, general, and administrative expenses, quite a lot here for the most part. They will have to bring costs down tremendously in order to start making some money over here, it looks like. So the balance sheet of the company, let's take a look as well. The total assets seem to be going down actually over here. That's not great to see. Well, let's take a look at the total equity of the company. Yeah, so the total equity of the company going down, losing money here in retained earnings. You see them in the negative, even though they actually sell some stock over here. Additional paid-in capital means that investors bought the extra stock that the company allowed them to buy. So they diluted the current investors, sold some stock, got this money from investors, and you see it here in the total equity. But the company is losing a lot of money. That's the big problem over here in terms of the company's total equity going down. That's not good to see at all. Cash flow. Cash from operations in the negative as well, as you would expect, based on the net income, and a lot of stock-based compensation for employees, which is always a problem if these kinds of companies don't make a lot of money. So yeah, insane expenditures here for the company. Cash from investing. Yeah, over here they actually sold investments. They sold a few investments over here, equities. Also not great to see. And for financing, they also issue common stock over here. Yes, we saw that. And there's no debt, but issuance of common stock. So basically, they are financing themselves from within, and you you could expect them to continue doing that unless the situation changes for the company. Free cash flow, again, losing money. So over here they were doing fine, but then things went south and kind of fixed themselves, but lost a lot of money in the last 12 months. I'm wondering why that much actually. Why so many expenses that led to negative free cash flow. You can always take a closer look and examine the company in detail if you want to know more about this. Now, when you have a negative cash flow, you cannot really give it a multiple, obviously, because it's negative, of course. But we do want to examine the solvency tab over here, see if the company has a risk of bankruptcy or anything of that sort. Looks like the debt, they have basically almost zero debt. That's why their current total debt to equity is 3.1%, is very, very low. But the problem is that they're diluting investors. So right now they're basically printing more shares, and you should expect the actual, let me go back over here, you should expect the shares outstanding to grow fast with this company. I think that's what's going to happen, maybe at $1 billion or so at some point, before they decide to get a debt in the form of a loan, because that's much more expensive for a company than issuing shares of their own. Now, would I want to enter this company? Look, there are some interesting, at least, things over here, like the projection of increased sales at some point, although there is also the projection of the sales getting reduced at some point. There is the projection of the EPS turning positive potentially in a couple of years or so. So I don't know if this is way too confident, maybe. You'll have to dig deeper to see that. There's the good thing that the company doesn't have debt, but the company is issuing shares and diluting investors heavily. However, there is also the very, very important thing that the company stock price is very, very low right now. So there is always a reward to risk ratio. And I'd say here you definitely don't want to go all in, because the company could even go bankrupt. I mean, who knows? If they continue not making money, they could go bankrupt. I mean, many companies have. Why not? I hope they don't, of course. But I think it may be beneficial potentially to play this company for sort of like a ride, a potential ride that could reverse the situation, but knowing that it could go south very quickly and you could actually lose the whole of your investment. So it's almost like a trade over here. This company is obviously not a long-term value purchase, but again, I'm examining everything, because when you're investing, you may not want to invest specifically at a company for the long run, but you may want to reap the benefits of a shorter run, or of a potential reversal of potential short interest rising and causing a short squeeze, potentially, if there are some good news in the company. And also the fact, which is also important, that the company at some point was close to 33. And this matters in terms of history, because this gives sort of like a resistance level over here and a support level. And if things return to normal for WIS, for ContextLogic, and they actually start making money and reversing the situation a little bit, you can quickly get a stock that rises very, very quickly to this level again. It could happen. I've seen it happen with many, many companies. And in this situation, you could actually buy, like, let's say 1,000 shares over here for like $2,000 and watch them grow tremendously, like from $1,000 to 30,000 or something of that sort. Like, obviously you have to be kind of lucky for this to happen, or the company, a combination of luck and the company reversing the situation. So the board has to do very well as well. And it's based on the financials, it's definitely not looking great. So while again, this is not a long-term play in terms of value, it may be an interesting play in terms of sort of like kind of like a lottery trade ticket, which you can get and just hold it for a couple of years, see how it goes. That's what I'd say for this company. But if you're examining it as a long-term play, as a long-term value investor, it's definitely a no for me, in my opinion. But again, for a shorter play, that's a potential, lucrative play that could turn your way. You're risking maybe $2,000 for a potential of maybe making $10,000. So the risk to reward ratio could be 1 to 5, something of that sort. So you can think of it this way, even for a kind of like a short-term trade in which you hold the company till it reaches 10, maybe, if it ever reaches 10, with again the understanding that it could go to 0 or lower than what it is right now, because the cheap gets cheaper. Doesn't mean that something that's cheap is gonna go up for sure. They have to make things better in order for the company stock price to go up, and this may never happen. So bear that in mind and understand that concept. And if you are willing to invest a little bit, just a little bit, with the potential of losing it, then you're good to go. Why not? You can try that, see how that works. So thanks for watching the video. Hope you enjoyed it. If you did like it, please take a look at this video that I created about Amazon. And in the meantime, you can also join our Discord channel. You can find the link below in the description of the video. And please join us, because we have some people already and we're discussing about all sorts of investments and investing potential decisions. And we're having some nice chats over there. So I'd love to welcome you. So thank you for watching, and I'll see you in the next video. Bye bye.